Welcome, everyone, to this very special webinar we have for you today. The U.S. 2024 election, and is your portfolio ready for the election? We are going to be talking through all things U.S. election related. And our special guest today is Blu Putnam, former CME Group Chief Economist and Managing Director. Thank you so much for joining, Blu, and I'm really looking forward to this conversation. We have a lot to talk about this evening. I just wanted to give you a chance to briefly introduce yourself so folks know who you are.
Hi, Blu Putnam. Very happy to be here. Short disclaimer, these are my views today and not those of CME Group or Saxo Bank. I'm a financial consultant now and happily employed, so I can say what I like. Anyway, we're going to have a good session. We're going to go from the economics to the politics to what your portfolio needs. So it's going to be fun.
Yeah, we have, in fact, the agenda for today on this slide here. So we've divided it up into three parts. We're going to talk about the U.S. economy. So really, it's really critical, election or not. I think the U.S. economy is in a very interesting spot here, and especially the timing, I think, is good as we're all shifting from one scenario to the next. Are we going to get a hard landing, a soft landing? And the latest has been we're going to get no landing. So there are many moving parts in the U.S. economy that are really critical and will, be very important as we look towards the election to see who's elected, because whoever is elected will have to deal with the particulars of the backdrop here. Then we're going to talk about specific U.S. election outcomes. This is the nitty-gritty of how a winner is determined, the likelihood of who becomes president, as well as control of Congress. That control of Congress is so absolutely critical, and we'll point that out and discuss how as well. And then finally, the different election scenarios. They're basically four that are realistic with varying degrees of probability. And we'll run a bit through in some detail on what the likely market implications could be for any of those four scenarios, especially the two that I think, or that at least I think, and perhaps Blu does as well, are most likely. Now, just to briefly, again, on this disclaimer front, Blu, you're clever to remember your disclaimer. I need to remember mine as well. What we are talking about today are simply our thoughts on the markets. None of this should be taken as a direct trade recommendation. There may be some points later on where we're talking, as the disclaimer here indicates, about some instruments, trading instruments that are not tradable for all retail clients, and they may not be appropriate for you. So just be aware of that. And again, none of this should be taken as a encouragement to trade. I want to call out CME Group as well and thank them very much for the collaboration here and helping us set this up with our special guest, Blu Putnam. All right, let's dive right into it, Blu. We have the U.S. economy pre-election. So I don't know where you'd like to start. We can start with your first line, talking about the jobs market. I think that is where everyone is really focused right now. Maybe it's a lagging indicator, but because the Fed has indicated it's going to be making policy based on where the labor market is, that's one of the reasons the market is so obsessed with it, because everyone's assumption is that for now, inflation is orderly. But I'll let you start where you want to with the discussion on where the U.S. economy is pre-election.
Yeah, let's start with the jobs because
Yeah.
the Fed has shifted to thinking as much about jobs as inflation and maybe more. In fact, if you look at the history of the Federal Reserve, even when they think about inflation, the jobs market guides their forecast. So a robust jobs market makes them a little more nervous about higher inflation, and when jobs aren't there, obviously a recession or something, they're not worried about inflation. So the jobs market is where to start. The U.S. jobs market, looking backward, is just fine. We've come out of a post-pandemic surge, and we are calming down to approximately where we were somewhere around 2018, 2019. So there's no sign of any recession, but the jobs market is slower than it was earlier when we were in the recovery from the pandemic. I would bring out one little point about jobs data. This is just a quick aside. We're going to talk about it a little later, but the jobs data will be disturbed by the hurricanes in Florida, Georgia, and North Carolina. So the November report for October, don't give it too much thought, neither will the Fed.
Yeah,
Um,
I'm sharing your employment claims data or chart
yes.
here, and we see that big uptick, and that was directly a cause or a result of that Hurricane Helene. And then we have this other one, Milton, which struck in the even more populated area of Florida. And I guess what was your estimate? Around 6 weeks plus of these weekly data points, like the claims will be impacted by those two storms. Is that correct?
Yeah, that's about right. We don't know how many, but we know a lot of businesses had to close. They can't reopen right away. In Florida, they'll probably get reopened. What's going on in North Carolina, which happened several weeks ago, is a little more serious. But anyway, just be aware that the jobs data, will be a little weaker in the next report, but it will come with an asterisk and probably won't matter for the Federal Reserve or the election.
How do you absorb this? You talked about you sound quite unconcerned for the moment about the jobs market. There's been this very much circulated, the so-called SOM rule, where it just says that when the unemployment rate rises some 0.5% off of its low, that this is has always been historically that sort of it snowballs, that unemployment snowballs, and it means we're basically headed for a recession. How much do you invest? How much credibility do you give to the SOM rule, and how much do you think this is maybe just some sort of normalization after a pretty zany, uh, you know, labor market we had post-pandemic when there's so much demand stuffed into the economy from the fiscal stimulus that we got to basically unprecedented levels of unemployment?
Yeah, I'm 100% with your latter definition. The SOM rule, by the way, Claudia Somm developed this as a quick indicator to tell the U.S. Treasury that they might have to spend more money if the unemployment rate were to rise and provide more insurance. But it was totally data mined, and she's adamant about pointing that out. That when we do know that when unemployment rises in the U.S., it tends to rise very quickly, but
Hmm.
we've never had the pandemic episode before. And so, we lost in the US, we lost 22 million jobs with the pandemic, and we got them back fairly quickly, but it wasn't an equilibrium market because some industries came back faster, others slower. And so I really don't think a data mine pattern recognition of the past applies to this pandemic. I think we're going back to a new equilibrium, something like 2018, 2019, but obviously not quite the same. Many of us, like myself, will spend a little more time working from home than I did before. But that gives a more flexible economy, and that's probably a good thing. But there's the SOM rule. I really don't think applies this time, and I think Claudia Somm would probably agree with that.
So your assessment then, soft landing, hard landing, you don't, certainly not in the hard landing camp anytime soon, but soft landing or essentially no landing is that what is your view here?
I'm in the no landing. Soft landing, at least it implies, I fly way too much, but when you're on an airplane and you come in for a really smooth landing, the plane still stops. And I don't see the economy stopping. I'm in the no landing, but we are probably flying at a little lower altitude. I mean, the demographics of the United States, the young people are not as many as they used to be. There are plenty of boomers retiring. The labor force shrinks, not shrinks, but slows its growth. And so that suggests that the U.S. GDP wise is probably a 2% GDP economy. It's not 2.5, 3. And so the job market could slow down to 100,000 jobs a month, 150, something like that. And by the way, the unemployment rate would stay in the fours, because that's enough jobs, given a slower growth of the labor force, to keep the unemployment rate about where it is, give or take.
Okay,
You
so
know.
with that set of with that no landing scenario then in mind, is there any risk then of a reheating of inflation in your view? If or are you comfortable with where inflation is headed and where it's come from and where it's going to? And
Well, we're gonna,
I'll share a
yeah,
couple of
let's
inflation
put some
charts.
inflation charts up to talk about that. This is the consumer price, the headline inflation, and it's compared to a year ago. So we're at 2.4% compared to a year ago. What you can notice here that we've gotten a little stuck around the 2.5 zone. We came, it went up to 9%. It came right back down to 2.5. but then we got stuck. And that's because, goods inflation has really gone below 2%, and service inflation, particularly shelter, next slide, shelter inflation has stuck up a little higher. In the CPI, shelter inflation has just literally in the last month dipped below 5%. Shelter typically is a lagging indicator. This is not as contemporaneous a measure. And if you take it out of the CPI, which is in the next slide, you're pretty low. Now, personally, I wouldn't take it all out. We do believe shelter inflation will settle in more like 4%, and it's about 1/3 of the CPI. So that brings us back up pretty close to 2.5. But in any case, inflation is not rising anymore. It's definitely under control. But whether it gets to the Fed's 2% target, that's a whole nother story. If you're very religious about 2% as a precise number, I have two comments for you. First, you're not a very good economist because we're not that good. And second is, you're still being a little precise. Anywhere between 1.5 and 2.5 would be victory for me. But then, that's my view.
So given that, and I think we'll talk a bit more about where the Fed is on all of this later. So the Fed seems, well, they cut by 50 basis points, 0.5% at their first rate cut for the cycle. The market thought this would be setting off maybe a series of larger cuts, but then some of the intervening data suggests that we need to pull back and be looking for more cautious cuts from the Fed. How do you read Fed policy here and what the interest rate, what the yield curve is telling us? So long rates around 4% for the 10-year, and how the market is sussing out or projecting the Fed funds rate next year. Do they ease just to get sort of a head start in case this is going to soften up a bit more? Because I mean, if with inflation down, they don't need policy up here, or just how do you read that whole bundle of questions I just threw at you?
Yeah, you got a lot to unpack there, but so let's take it. The Federal Reserve is probably headed to what they would like to call a neutral rate. By the way, the neutral rate, some economists call it R star. They spend way too much time on this, in my view. It's a mythical concept. It's unobservable and it doesn't exist, but we're all trying to figure out what it is. And we think it probably depends on two things. The short-term rate that the Fed sets in a neutral kind of scenario would probably be a little bit above the inflation rate. So if the inflation rate is, let's just say it's 2.5, and the current Fed funds rate is 4.75, you got a lot of room. When I say a little bit above, I think the Fed would argue, some people would say, let's be 50 basis, 0.5% above the inflation rate. Some would say a full percent, but that puts us in the 3 to 4% territory for the federal funds rate. And I think that's where they want to go. Now, the Fed is data dependent. And what does data dependent mean? It means you're driving your car looking only through the rearview mirror. My lawyers have advised me to tell you not to do that. Okay. But the Fed does it. And the Fed does it because they're not comfortable with their forecasting ability. That's actually a pretty good assessment of their forecasting ability. So they're realists. But it does mean that you're going to be a little late. If the economy were to tip into a recession, they would not figure it out until we had all gotten the email. But right now, we're not in a recession. So we just think that they just want to find a more comfortable area. There's no reason to be restrictive with the inflation having come down. And, the employment picture is good, but it's not like inflationary or too aggressive. And so on that count, it's a good time to head for neutral. But the Fed's a super cautious body.
Mm-hmm.
So, that 50 basis point cut was a catch up, and they've made it really very clear that that's not to be extrapolated. So 25 basis points until they find somewhere that they're comfortable with setting up, and they probably will find that comfort zone about the middle of next year, something like that.
Okay.
And that's, of course, now there's still a possibility of recession. Recessions happen. There are some people that just keep forecasting recessions, and they're right like a stop clock twice a day, or twice every 2 decades, But right now, I don't see one.
Let me take one additional question, just to sort of challenge, or to say if this also echoes what we just said about the oddness of this post-pandemic economy, where there's so much, such a demand injection requiring and generating so much inflation, and then therefore requiring such a vicious or a strong Fed response. Clearly, that also affected the yield curve, which inverted profoundly and stayed inverted. So when I say that inverted, I mean that the short rates went above long rates for the longest period, essentially in modern history. I can show you a chart here. This chart I put together
Oh, yes.
showing the inversions are sort of colored red here. It's a bit of a busy chart, but the right-hand side showing you where the Fed funds rate is, the left-hand side showing you the yield curve slope, and the colored areas are when the yield curve is inverted. And this classically happens. It has a very high batting average of almost 100%, but it's also very few observations. If you look back at the late 80s into early 90s, that was a recession. The one into 2001, that was another recession, of course. Great financial crisis. Actually, didn't even see that profound of an inversion, but it was quite extended the area where it was flat before that unfolded, and then this incredible experience here. So, do you think this is just an artifact? This what many fear now is a harbinger of a hard landing, or is this merely this very odd just extremes of the pandemic swings, policy wise and economic, that we've seen over the last few years?
I think there are two things you have to take into account when you're looking at the yield curve as a predictor of inflation. The US economy is no longer very interest rate sensitive, but it used to be. In the 50s, 60s, 70s, if interest rates went up, it was harder to get a car loan, it was harder to get a mortgage. Effectively, the financial sector shut down and we had a recession. By 1990, that was still true, but not that true. There was one set of institutions still left that were very interest rate sensitive. In the U.S., they were called savings and loan. You're in
Hmm.
France or something, they're the Castaparn. But these savings and loans, they lent money over 30 years for home mortgages, and they borrowed it from their depositors for 3, 6, 9 months. So they were very interest rate sensitive. When interest rates went up to 10% in 1989 and the yield curve inverted, these folks went broke. After that, I don't know of any major financial sector of the economy that wasn't aggressively hedging or managing their interest rate risk. And the more you manage your interest rate risk as an economy, what it means is the Fed's less powerful in terms of a change in interest rates impacting the economy. It'll still happen, and changes in interest rates have a profound effect on asset prices. I mean, interest rates are directly related to bonds and they provide the benchmark for equity. So it's going to affect asset prices. But affecting the economy is not as powerful as it used to be. So that's one thing. The second thing is that when the yield curve inverts and short rates are very high, you have to figure out who's going to be hurt. You only get a recession when there's enough damage to the economy to domino through the whole thing and cause a recession. So in 1989-90, that was the savings and loan crisis. In 1999-2000, we had what was known as the tech wreck on Wall Street. You may remember these tech companies at that point did not have earnings. Everything was in the future. So higher interest rates meant you discounted that and whoops, got to lower those values. And then, of course, we had the Great Recession, which higher interest rates caused a problem with credit, subprime mortgages. And then there was the pandemic, which had nothing to do with interest rates. So if you want to use the yield curve to forecast a recession, you have to tell me who's going to be damaged by the yield curve and will it be enough to sink the economy. And in 1950, in the US, we said, as so goes General Motors, so goes the economy. Higher interest rates kill the auto market and the housing market. That doesn't happen now. So, interest rates are still important, but they are not as good a predictor of the economy as they once were.
What a tour de force of an answer. Thanks, thanks so much for that one. I really appreciated that answer. I must say, I've never heard it explained quite so clearly before. All right, I think as I was afraid might happen, we've dug into the U.S. economy for quite some time. We probably need to get through the next section a bit more quickly. So we'll get into a little bit on the election itself and scenarios around who wins. I'll lead off a little bit here with some observations. Many of you out there are probably quite familiar with it. It's too much detail to go into to explain the so-called electoral college system, residual of the 18th century design of the U.S. Constitution, which means that a president is not elected by popular vote, but elected by state electoral votes, which in 48 cases of the 50 states is comprised of how many House seats you have and plus 2 senators. And because every state gets 2 senators, no matter how small, the minimum number of electoral votes you can have is 3. And because Trump tends to do better in the smaller states, that is how he is able to lose the popular vote in 2016 and become president. And he lost the popular vote by quite a margin in 2020 and of course was not president, but barely missed becoming president if just a few states had swung his way. That is why there is so much focus on a handful of so-called swing states, and that is this map here. 270 win, great website. You can see that there are about 226 electoral votes that are seen going to Democrats under just about any scenario, and about 219 to Republicans. And therefore, there are only about 7 states that we need to really focus on to see who will win this election. And the most important for Trump is to win at least one of these Midwest states up here: Wisconsin, Michigan, Pennsylvania. If he wins none of those, Kamala Harris wins by a very tiny margin of 270 to 268. So critical to understand that bit. The polling in these swing states is impossibly close. There seems to be maybe a little bit of a lead, for Harris, whereas Trump is performing better in, for example, Arizona and Georgia than he did in 2020. So it really becomes a focus on the Midwest, I think, for Harris to win this election. As we know, the big shift in 2016, there was especially a massive shift in the Midwest of voters up here, traditionally Democratic areas, giving up on the Democratic Party and voting Republican. You can see that in this New York Times illustration here. That was the most notable shift nationwide. Then in 2020, the big shift was border states and the Hispanic vote becoming surprisingly Trump relative to prior election cycles, and Ohio and Florida sort of cementing themselves as real Republican states rather than being swing states anymore. Florida used to be the big swing state prize. That is no longer. It is now considered Republican country. So again, just to underline, Trump lost massively in terms of the absolute popular vote count, 7 million, which is 4.5% of the popular vote. But if you look at the combination of Wisconsin, Georgia, and Arizona, his win totals there added up to 43,000 votes, or 27/100% of the U.S. Popular vote count. So just incredibly small swings there. And there is the theoretical possibility, this is a very unlikely map, but there is the theoretical possibility of a 269 to 269, which would mean each vote basically gets to vote for who's president. I'll let you break in a little bit here, because I remember I didn't hear your explanation, but we had a brief chat, Blu, about these election odds sites that are supposedly gaming. They're not supposedly gaming. You can actually bet real money on these places for various outcomes and win and lose money based on those outcomes. But in this case, we have both the election winner odds here, 56 to 44. So we've seen quite a move. And the reason I crossed it out is because over the last just few days, we've seen quite a shift in Trump's favor. And then we have the different scenarios for also for control of Congress. But maybe if you have a brief word, Blu, on why you don't see these election odds sites as providing such good indications, particularly good indications.
Well, there are a couple of things. One, they're national polls, and as you just mentioned, we're looking at 7 or 8 states that matter the most, and the states are much harder to get an opinion poll on. So that's one problem. Second problem, the pollsters have gotten not things quite right in 2016 or 2020. And so what are the question, what do pollsters do? Well, they don't, if they're getting things wrong, they don't do it the same way. And what they got wrong, particularly in 2016 and a little bit in 2020, is they typically underestimated the vote for Donald Trump. And so now the pollsters are trying to correct for that. And I say trying, we don't know if what they're doing will work or not. But if they call you, of course, I wouldn't be even answering my phone if I didn't know who was calling, but some people apparently do. And if you answer your phone and they ask you who you're going to vote for, and you tell them, they will then ask you, who did you vote for last time? Surprising number of people apparently can't remember. But at any rate, they're trying to really assess whether or not you are firmly in one camp or the other and trying to correct for some of the mistakes of their past. And they don't know if this is going to work or not. We just know they're trying. Um, so I do think that, I mean, these people they're really working hard at what they do. So I think the polls are probably better than 2016. I don't think we're underestimating the Donald Trump vote as much as they did in the past. But polling has gotten very hard. I mean, people just, you're mostly on your mobile phone. You can see who's calling. They also try online systems, but a lot of people, and by the way, a lot of people lie on the polls. They don't lie about the candidate so much as they lie about all the other questions. They take the extreme position. So polling is a very, very difficult art, not a science.
Great points there. And as well, I'm not picking up the audio on your side. I'm not sure what's happening. No, it seems okay now. In 2022, we actually had the opposite swing where the polls were overestimating the Republicans, and it turned out they did very poorly, whether that was the abortion issue that was sort of happening just before the election. Hard to know. But yeah, but interesting to see how the polls got things wrong, as I show here. In 2016, of course, this was in a particular date. It wasn't on election day, but there were some extremes in some of these that were just obviously way off. Wisconsin supposedly something like 6 or 7 points in favor of Clinton, and she actually lost the state. So I think it is very difficult to know where we are with the polls.
Yeah, it is. And you can also go to betting sites. By the way, they're not any better, but they're wrong for different reasons. Betting sites are capital weighted. The people with the most money may bet the most money, and that can tilt it. The classic case on this one was Brexit back in 2016, where the big money in London said they were going to stay or remain, and the small money, but with lots more voters, in the rural sectors, said no, we're going to leave. So I don't trust the betting sites either, because you don't really know which one of these billionaire donors is trying to influence it one way or the other. But it's not the same as a futures market. I can tell you that.
Yeah, and we do show the betting market here, polymarket.com. There's something like $1 billion, I think, a bit more now, betting on this outcome here. And then I think just briefly, we ought to go through the scenarios and why these are important and why there's such a tilt in the different specific outcomes. And when I mean specific outcomes, when I say specific outcomes, I mean it is not just about who becomes president, but whether they have control of Congress, as we saw with Trump 1.0 and as we saw with Biden once it became clear that he would just get control of the Senate with that key Georgia Senate election. That when you have control of Congress, your party does, you are able to do big things in a fiscal and tax reform way. So the Trump tax cuts were only possible because he had control of Congress as well. And that's why we really need to consider these scenarios, because I think the Democratic sweep scenario is far smaller, far less likely, and betting markets do as well, at 17% than the Republican sweep scenario, which is currently the favored outcome at 38%. I don't know what you make of that. You made a comment, and by the way, if Harris does win, the Senate election map is seen as extremely difficult for the Democrats. There are a number of reasons for that. I don't think I want to go into it here, but it's basically a couple of them are almost certain to flip to Republican. And it looks almost impossible for the Democrats to achieve control of the Senate unless there's something very wrong in the polling here, almost across the board. So the two scenarios then are Trump wins and probably gets Congress, and then Harris wins, but the Senate fails to the Democrats fail to maintain the Senate in their hands. But I found a comment you made quite interesting, Blu. It sounds like you think that the scenario in which Trump wins and the Republicans get the Senate, but the House fails to go to the Republicans, is perhaps a more salient risk than these odds would suggest at 14%?
Yeah, I would put them quite. My odds would be very different. We're in total disagree. I mean, total agreement on the Senate. The
Mm,
Democrats have to defend like 23 out of 33 seats, and we already know they've lost two of them, and they
yeah,
can only lose two. So they've got to pick up something, and that's looking pretty hard. So that one, that there's a consensus on that the Republicans will flip to own the Senate by one vote.
yeah,
But the House is very different because in 2022 the Democrats lost a lot of seats in New York and California. I mean, when I say a lot, they lost just enough to lose control of the House.
mm,
It's only a 4-seat swing out of 435
yeah,
congressmen. So these are blue states in the sense that the Democrats are going to win these states. And a lot has changed since 2022. Typically, in the US, in an off presidential year, the House goes away from the president. And that's a very stable pattern.
yeah,
You spend 2 years with whoever's president and you think, well, maybe I'm not so sure. And the president's not running. And so, in the lingo of the campaign, he has no coattails or she has no coattails because it's an off year. So,
yeah.
2024 is an on year. So, we expect the president to carry some voters with him. I will say that what we call splitting your ticket, voting one way for the president, a different way from a congressman, is a lot more easy and common than it used to be. You know, I grew up in the American South, and it's not a great example, but there used to be a voting machine where you could just pull one lever and you would vote the entire ticket. Those voting machines are gone. So
Mm.
now it's fairly easy to split your ticket, but still people don't tend to think that way. But we do expect that the Democrats can pick up a few seats in New York and California, and just enough to flip the House back to Democrats. But this is my assessment. Obviously, some other people have very different odds.
No, I think it's a really important one to consider because I think it's a very, very different scenario when you have a blocking House to Trump's agenda. It means that, for example, the further corporate tax cuts that he would like to implement would simply not be passable. I don't see a Democratic House passing further corporate tax cuts. But it gives us good excuse then to dive into the scenarios, the market implications of what's about to unfold here. And this rather busy slide, I don't want to go through it sort of point by point, but I think we need to pull out some of the big headlines here from if we do see what is supposedly the most favored scenario, and that is a Trump sweep. In other words, Trump wins and gets full control of the Senate. The Republicans get due of the Senate and the House. His platform has promised the 15% rate for corporate taxes from the prior level he implemented at 21%, and that eventually they would make the other tax cuts and Jobs Act tax cuts permanent, the ones for individuals and inheritance, etc. Of course, this is just simply positive for all stocks. You can easily argue because it just means that corporations are paying a lower tax rate. You adjust the model values higher. Now, tariffs, that's a big question. And some have argued that we need to be careful about playing, just replaying the 2016 playbook because he wants to be tariff man, maybe even bigger and better this time around versus 2016. And they are definitely not a positive for the market because they are stagflationary. They impact growth negatively and they impact inflation on the upside. Then we have geopolitics, where we know that Trump is no big fan of the NATO alliance, or at least shows a lot less shine for it than is traditionally the case for the U.S. since World War II, and he's very firmly anti-China. We think, at least at Saxo, we've talked about one of the positives there would be European defense, feeling like that U.S. security umbrella is rapidly diminishing in the years to come. Sort of kicked off by the first Trump administration. And then more on the market positive side, there's the deregulatory desires of a new Trump administration, rolling back ESG requirements. So the traditional pro-growth, anti-green agenda moves that he's been in favor of, and even maybe trying to stop some of the spending that's been unleashed by Biden's Inflation Reduction Act that hasn't been spent already, and maybe even some of these Dodd-Frank rule changes that were all the legislation that was developed in the wake of the global financial crisis. So that would be positive if the move is seen as following through in a Trump sweep for banks. Although we think this would be very negative for bonds. So we think interest rates, long-term interest rates especially, would rise quite quickly, and those regional banks might have some problems with their held-to-maturity portfolios. But financial services in general, positive. U.S. automakers, positive. Fossil fuel companies, and yeah, maybe crypto positive. We won't go into crypto here, but general assessment, by far the most inflationary outcome. That's my view. I'd like to hear your rebuttal to or confirmation, whatever you believe in a few of these points, Blue, or anything you'd like to add. But this inflationary outcome, it comes from just again tearing out the supports from under the U.S. Budget and seeing another, adding to deficits in a time when we're not even in recession, and doing so in a sustained basis. How do we hold up? How will the Fed react to keep the bond market orderly is almost my question. And I think that's the big risk of a Trump 2.0. And as I note here, very gold supportive. Blue, do you have anything to say to that?
Yeah, I think we need to understand some of these things the president can do on his own. Tariffs are one of the things where there's quite a lot of ability of a president to change tariffs. U.S. has a very complicated tariff system, and so some of that can be done by executive order. Some of the bigger changes that Trump is talking about would require the help of Congress, but he can do some of his tariffs. I think he did a Bloomberg interview today, and he said tariffs was one of the most beautiful words in the English language. He's definitely committed to tariffs.
Yeah.
You don't. I'm an economist by training, and you're not allowed to call yourself an economist if you don't believe in free trade. It's just something that's in our DNA. So I do have a bias there, but in general, tariffs are some kind of a tax, and somebody's got to pay for it. And the question is who? Is it the company overseas or out of the U.S. that builds the products? Do they pay for it? Or is it the consumer in the U.S.? Most economic studies say the consumer pays for it, but somebody's going to pay. And so there's going to be a cost to the economy from one direction or the other, and it's going to slow down. So, we're a little worried about the tariffs, but, Trump put a lot of tariffs on China, and the Biden administration did not roll them back. Okay, so depending on the country you're talking about, this is a little more of a bipartisan issue than you might think. We'll have to see on tariffs. One of the things that, changing the subject slightly, that I'm very worried about are things that the Congress and the president have to do before they can do anything else. And the U.S. has two things coming up. The Congress needs to officially fund all the government agencies, and the U.S. fiscal year ended on September 30th, and they passed what they call a continuing resolution, but they funded the government through December 15. So, as we say, a lame duck Congress, after the election, but before the new Congress is sworn in, is going to have to fund the government. That's going to be hugely contentious no matter who wins. So there's a chance that a partial shutdown of the U.S. government could even happen before we know anything else. By the way, that's 1 million people getting furloughed. They all know the drill. The U.S. has done this before. They're going to be off for 2 to 3 weeks, and they're going to go back to work. They're going to get all their back pay. So they head straight for the DIY store and renovate their houses. So that's not a huge deal, but it's still a problem for the incoming president. The second thing that happens is on January 1st, the U.S. has something called a debt ceiling. Nobody else has these things for really good reason. But the U.S. has one, and the debt ceiling will go in effect on January 1st at the current debt level of the federal government. So, sometime around $35 trillion, give or take, that'll be the ceiling. And then the U.S. Treasury Secretary has plenty of room to stay under that ceiling for 6 to 7 months. So, around July, that's when you get the debt ceiling crisis. And that's much more serious because there are maybe 20, 30 congressmen on the Republican side that would be okay with shutting it down and defaulting for a week or two while they sort this out. The last time this was so serious was July, August of 2011. That was President Obama. They reached a spending compromise that dramatically controlled very tightly spending for the next 6 years. And so the US deficit actually shrunk. Um, but, all I'm saying here is that before you can even do your tariffs, your taxes, whatever you want to do, you're going to have to get through these two problems of funding the government and dealing with the debt ceiling. And they will be probably more contentious than in the past, and they've been pretty contentious. Again, back to August 2011, Standard & Poor's actually downgraded U.S. debt. That didn't work out because when you get to a debt ceiling crisis, you don't know what's going to happen, so you still go to safety, and safety was U.S. Treasuries. So don't take all my comments to mean you should sell Treasuries, because if we have the crisis, maybe you should buy them. Uh, it's just a mess, and that's all before we get to taxes.
Yeah, and there's an irony there, as you said, downgrading the world's safest instrument. What are you supposed to do then? I need to tell the viewers one thing here. It's very important to if you want to ask a question, there's a questions module in this app that you're viewing this in. It's up on the right. It's questions. There's a Paolo that was very clever and jumped in with a question before the webinar even started. But feel free to any questions that are coming up as we're going through this. We're getting towards the end. We want to leave a few minutes for some questions for you at the end here. Please do ask any questions you might have, anything specific or general. And there also is a handouts section where you can see the PDF of all these slides. There are a few slides we may not have gotten to. You may want to revisit some of the ones we've discussed already. So you can find the PDF in the handouts section. So I just wanted to point that out before you pick up the conversation again. And yeah,
We
I
should
mean,
probably talk a little bit about which equity sectors or indexes might be hit or not hit. You really, if you're doing looking at the U.S. equities, you've got the S&P 500, the Dow Jones, the Nasdaq, and the Russell 2000 small cap. Let me start with the Russell. The Russell 2000. These are small companies. That's the green line on this chart, and they rallied back in July, but they are not as impacted by tariffs. These are much more domestic companies. They may face foreign competition, so they might even do better. NASDAQ is really the tricky one because a lot of the tariffs might see retaliation on technology companies, particularly related to China or India. So I would be a little more worried about NASDAQ with tariffs than maybe the Russell 2000. The Dow and the S&P 500 are broad-based indexes that are kind of in between on my view there.
great. And then let's talk a little bit about the what we might see in a Harris gridlock scenario. To me, really smacks of status quo. I mean, we have, yes, the different houses of Congress would flip. We currently have a Democratic Senate and a slightly Republican House. We would have the opposite, and most likely, if we were to see Harris winning the presidency. Is there anything you would want to point out there? And actually, your bipartisan point on tariffs is really critical, because something like Chinese EVs, for example, it was the Biden administration that slapped a 100% tariff on Chinese EVs. So it's not like tariffs are only about Trump. He just would like to reach out to tariffs for a much broader application of them, even to European trading partners, relative to what I think the Democrats are likely to do. But I'll share the sort of the slide on Harris gridlock. status quo. This is the most predictable outcome, really, because this is what we have. We kind of know this already. We have the inability to make anything dramatic or new on the tax policy front. We won't get new corporate taxes. Sometime next year, they'll have to agree on the extending the Trump tax cuts or not. Otherwise, we face a bit of a new tax bill. Um, and yeah, I mean, I would say this is just sort of the least inflationary scenario, and we just kind of revert back to tracking how the U.S. economy is shaping up for itself, and track all the issues we've been tracking. What's going to happen with the outcome of the war in Ukraine? What new measures will they take in what is a bipartisan and more assertive approach to China, which we're clearly seeing as a global rival? And also, Blue, I think one of the interesting things I've discussed with others, is the you try to tariffs are like sort of a game of whack-a-mole, right? You put your tariffs on China, and then it's you have the People's Liberation Army accessing chip resources over the wire and using data centers in the cloud in the U.S. Or they're getting chips transshipped via other countries, just like Russia is skirting a lot of the sanctions against it by transshipping things from Turkey and the Caucasus nations, etc. Is some of it a little bit of is it theater, or do they really think they can follow through and really um, impact impact the flow of actual goods
No.
to the degree they want to? I think it's an
Yeah,
open
it's very
question.
hard. You think tariffs are like a rifle. You aim a tariff at a particular good and it's
Mhm.
going to only affect that good. If you believe that, I got a bridge to sell you, okay? Because what happens is the tit for tat doesn't respond to what, if the US says, well, we don't want EVs coming from China, then China says, well, wait a minute, we're not going to buy your corn and soybeans. I mean, we know from the tariffs that were put in the Trump administration that the U.S. farmer paid the price, and they weren't even involved in the first gunshots.
Mm,
And that's what you have to realize is that countries will retaliate, but they retaliate in the way that they think they can hurt the U.S., which is not the way the U.S. thought they could hurt that country. So it's a very, very messy situation on tariffs. The other thing I would suggest that you think about that if the Democrats win and Harris is president, you're probably looking at much more predictability. That's kind of a corollary to gridlock. We
mm,
kind of understand what she can do, what she can't do. And by the way, if presidents don't control Congress, about the only thing they can do is foreign policy. Congress
right.
has very little to say. So, issues like Russia, Ukraine, and the Middle East will come to the fore because that's something you can focus on when you don't have Congress. But the real point I want to make here is that volatility declines, uncertainty declines. You kind of know what you're getting. If the Republicans win, you're going to get version two, but we know it's not going to be like version one. It's going to be much more aggressive. And it's really kind of hard to predict. Well, it's very hard to predict. So, from an investor standpoint, I'm looking at more volatility under one scenario and considerably less volatility under the other.
So
So that would,
less volatility is good. Harris gridlock is good. Trump gridlock still perhaps better in terms of volatility only. I'm not talking either politically here, just purely volatility and maybe market comfort. Trump gridlock maybe a little bit less so because he would still perhaps try to do more of the tariffs via executive order than a Harris uh, might do in a gridlock situation. I've put up, and the odds, I apologize, the odds don't match the odds in the previous, I hadn't updated those from the previous polymarket.com odds, but I just wanted to point out very briefly that I've put in some ideas here as well for a Harris sweep scenario, which I think is the most unambiguously sort of immediate negative for the market because they have to redo the valuations for companies because that means corporate tax hikes are coming again. She's promised a 28% corporate tax from the 21% under the Trump tax reform. So that's chiefly the only reason. I don't think she's going to be nearly as aggressive on creating deficits. Most of the estimates I've seen are that her deficits under a Democratic sweep scenario would be about half of what they would be under Trump. And then we have Trump gridlock, which maybe in some ways is a bit maybe to play to your risks there of budget showdown, budget ceilings showdown, and government shutdowns, etc., might be the most confrontational type of scenario I might imagine between how Trump behaves as president and a Democratic House might treat him. But that's speculation. Um, yeah, and then I think we're running out of time. I'd really like to get to our questions, but I think along your point of market volatility, I'd like to hammer that point home. Um, and I've done it a little bit on this slide here. I won't get into all the points here, but sort of election impact. Trump sweep, I think it's just sort of a force 10. On a scale of 10, it's as big as you get because, as you say, more forceful on tariffs, more forceful on policy with the control of Congress, especially if this politicization of the Fed bureaucracy goes through, etc. Trump gridlock, force 5, arguably. Maybe I'm wrong. Maybe the Harris Democratic sweep would be somewhere in between that and the Trump sweep. And then Harris gridlock is sort of the least volatile, the least impactful of all the potential outcomes. And so the more force is involved, the more you want to allocate potentially to optionality, to having some gold as a safety, and allocating that from your bond traditional bond allocation, because we're not a friend of bonds in a volatile Trump sweep scenario. A bit weighting heavier on the commodities and hard assets side as well. But regardless of what happens, we have all of these mega trends in place. If you want to respond to any of that, Blue, feel free. I'll start to pick out a question or
Yeah, you
two.
can pick out a question while I just highlight a few things.
Yeah.
The Trump campaign has talked a lot about the Federal Reserve and reining in its independence. That's generally bad for the U.S. dollar. We think that tariffs would not be good for the dollar, but we don't know how much. So you're looking at a little weaker dollar scenario under a Trump presidency. Whether that happens right away or takes its time, who knows? But that would be the scenario there on the Fed side. On the commodity side, China has already moved against U.S. farmers. And, the huge winner in the Tariff 101 was Brazil,
Mm.
and they've already expanded. So I don't think the U.S. corn, soybeans would be that much affected by the election. I think that's done. EVs are a very interesting thing because while it's a big political issue, we already know that the American consumer is much more interested in a hybrid than a pure EV, and that the automobile makers are already scaling back their investments into pure EV. So, in a way, the market has already front run the consumer, and forget about the election on that one. So, I don't see too much there. Things that involve global security, like chips, that's huge. And former President Trump, has been willing to single out companies. So while I was talking about NASDAQ, he's going to be talking about the company he chooses that he likes versus the one he doesn't like. And so the Republican scenario is much more of a stock picker's market, and the Harris scenario is much more of an index market, if you will.
Yeah. And you've
So those
seen
are just some quick thoughts.
excellent ones as well, and I think it's why you've seen your very important point on the way Trump operates and it being very specific and personal. You've seen this interesting rapprochement, or whatever you want to call it, the signaling, if you will, from Mark Zuckerberg of Meta after he was the one that shut him down on social media. Um, you know, some friendly gestures his way there, and then the one that's gone really all in, all chips on red, if you will, is Elon Musk. Obviously, I think he'd like to get into Trump's ear in the event that Trump wins, to help shape the regulatory environment, both for Twitter, but especially for the autonomous driving of Tesla. So that's a big regulatory hurdle that needs to be removed. That Tesla is to have success in that area and being allowed to do that area sooner rather than later. A slow moving bureaucracy might take 10 years before they approve
For
autonomous
sure.
vehicles, but a Trump, bull in a china shop approach might get it done quicker if you have his ear as somebody that donated $45 million a month or whatever it was to his campaign running into the election. I think we addressed then the first question we had. That was from Paolo on commodities are likely to perform best. I think there are other commodities we haven't mentioned that I think are really going to be more about China and whether it goes all in on stimulus, things like copper, iron ore, etc., industrial metals. But Yeah,
Yeah, China's the issue for industrial metals. I mean, China is a very weakening economy, and you can talk about property, you can talk about the new stimulus measures, but their destiny is their demography. Uh, there are not many young people being created. There are plenty of old people retiring and living longer. That economy is simply not going to grow as fast as it once did, and I don't. They can allocate money to the central bank to buy equities, or the central bank can lend money to other agencies to buy equities. So the equities may perform, but the economy, I can't see it. They really have to deal with their demographic destiny.
yeah. They're beset with a huge period of malinvestment and debt, and it's really a difficult
So
situation when you're
that's not the
about.
U.S. election. That's something else. And
Yeah,
you
that's
know, and if you're talking about oil, you're really talking about if the Middle East wars expand and eventually shut down some oil production, then we're going over $100. But if there's nothing like that happens and we still have the oil supply and China's slowing down, we're probably declining from here. So it's very much a two scenario thing, but it doesn't depend on the US election.
right. More importantly, I think one Peter asks, Trump recently said that he feels the president should have a say over decisions made by the Fed. Um, to what extent is this even feasible, and how might this impact interest rate regulation in the stock market? Well, I think it's a key question. You alluded to it, Blue. There's how much do you think would be, well, it was clear he was complaining back in Trump 1.0, late in 2018, when he felt that it was clearly the Fed's aggressive, what he felt was aggressive, and the market felt was aggressive. Rate hike regime was impacting confidence. Um, my suspicion is that it's less about the politics of it and more about that the dynamics of the deficit being so alarmingly the deficit being so alarmingly extended, the national debt situation, and the cost of financing that debt, that the Fed is just sort of forced to clamp down and to or not to clamp down, but to uh, by use of force to keep things orderly, rather than that's because they have a need to support or not support the economy. They just need to keep the bond market orderly. Do you agree with that, or do you think we're not that close to this sort of disorderly treasury market risks that are risk if we just have forever large deficits and no sense of any you know management of the situation?
I think we're a pretty long way in terms of years when
Okay.
the US deficit causes a serious problem for markets. By the way, if you talk to if you're a reader of Ernest Hemingway, how do you go bankrupt? Slow, 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 all at once. We're in that slow, slow, slow period. The deficits can get a lot worse before the market decides they're too bad. But when they do decide, when markets start taking it much more seriously, you will know because the US dollar will slide.
Hmm.
Countries that get in serious debt trouble and can't manage their fiscal policy eventually have a seriously weakening currency. We're not talking 3, 4, 5% here. We're talking 15, 20%. And that's just not happening. The US dollar is still the dominant currency in the world. And the Fed, let's go to a second point. The Fed has always been way more political than they would like to admit. And John mentioned that. In 2018, there was a lot of hammering on the Fed from the administration to stop raising rates, and they did. Equities, by the way, swooned. When you raise interest rates, equities aren't going to like it initially because they're discounted against the rates. But so this Fed has been more political than they would like to admit. But Jay Powell is unlikely to want another term. I don't know what he wants, but I think either president is likely to appoint somebody new. And that president can really make a big difference on whether they want a stronger or a weaker dollar. But that appointment is not in 2025. That'll be
It's
early
26.
2026.
Yeah.
We're not, regardless of what happens on that November 5th night, I wouldn't be buying or selling the dollar on the election immediately, but maybe down the road, I'd start worrying about it.
Yeah, I think particularly under Trump, the moment at which, nominally it's been discussed that his policies are quite dollar positive. The idea of tariffs and a more strongly growing economy from supply side, fresh supply side stimulus. But as you point out, if that eventually runs into the need to or desire to manipulate the Fed to get the dollar lower, they can get what they want on that side of things. All right, I think you know what, we're running up on the hour here. There was a question: is this webinar recorded? I certainly hope so. I think the tool is designed so that we record these webinars. So we will send out a link to everyone that is here and participated, and you can rewatch that. You can share with anybody you'd like to share it with. So that's of course something we would encourage, and it's quite easy to do. So stay tuned for that. Blu, thank you so much for enlightening us all with your insightful analysis and discussion of all these topics. U.S. election related. If you'd like to listen to us again, we haven't set the date 100% yet, but we are looking at doing a post-election webinar that you can find where you found the sign up for this webinar. You can always go to just Google Saxo webinars. It's the easiest way to find where you need to go to register. You can find it on platform if you're a Saxo client as well. So you can look forward to that. Once again, thanks, Blu. Thank you, everybody, for attending, for your questions and attention.
Thank you.
And we'll see you next time. All the best.
Next time.